gone for their cup of tea. It's okay. I'm going to speak on stable coins. And the reason I thought I should speak on stable coins is because of the increased traction that this particular instrument has had in the last couple of years. I have spoken about cryptocurrencies in general and stable coin as well. In fact, I've spoken formally in 2022. So I thought the gap is long enough for me to put down on paper what my views on stable coins are. The idea is to invite debate. The idea is to spread awareness. If I'm right and that I'm right about the risks that they have, I think others should know. If stable coins have advantages that I do not quite see at this point in time, I think it's a good thing if those advantages are also discussed rigorously in public. The purpose of this talk is to start that discussion. Therefore, I have a prepared speech, so, pardon me. It's a bit long. I've tried to cut it down, but I thought since it's going to be a formal speech, one must cover all aspects. So, I will read through the speech now. Thank you. It's a privilege to be able to stand here and talk to such a learned gathering, and I'm thankful to Mint for inviting me. Money, as we know it, has been a central pillar of human society for centuries, enabling trade, facilitating economic activity, and underpinning the very notion of trust in social and financial interactions. Over time, the form of money has evolved with technology, from commodities to metal to paper to balances in deposit accounts to now digital tokens. While the forms of money have evolved with technology, the fundamental character of money, what it represents or what gives it credibility, has always been that money represents value that has users' trust. The value is either intrinsic, if it's metal money, gold coin for example, or derived from a promise to pay, paper money or deposit money. A currency note is a promise to pay by the central bank. A deposit balance is a promise to pay by the bank with whom you have the deposit. So they are either intrinsic, the value is derived from the fact that it has intrinsic value, or there is a promise to pay by a trusted person, by someone you can trust, users can trust. Theoretically, money can be used by any person as long as he has the trust of users. The more stable forms of money in history have, however, always been issued by sovereigns. There have been stages when there was private money, but the more lasting phases, and over the last couple of centuries, the phase that has pretty much stabilized is where money is issued by sovereigns, not by private issuers. Examples of private money can be found in history, but they have not really been stable arrangements. In practice, therefore, money has credibility because its value is promised by the sovereign. Now, this fundamental character of money is under challenge from cryptocurrencies. Not in terms of technology, because money in the form of digital tokens can exist without changing the nature of money itself. You can have CBDC, that's a digital token. But the fundamental challenge of cryptocurrencies is that they claim to change the very nature of money. because cryptocurrencies do not represent value, either in terms of intrinsic worth or in terms of any promise to pay. In this talk today, I propose to explore what the nature of such a challenge is, what the exact nature of such a challenge is, and what are the implications of cryptocurrencies for the financial system as we know it. But to be able to understand the nature or character of money, we need to look a little bit deeper. I explained a little bit about how the character of money has evolved, but what exactly are the attributes of money? In a modern economy, there are two types of money: currency and bank deposits. Currency, physical, is issued directly by the state through its central bank, while deposits, digital, are issued under license by commercial banks. All money is issued either directly by the central bank or indirectly through banks authorized by it. Thus, all money in modern economies is effectively fiat in nature. It is this fiat or sovereign aspect of modern money which creates trust in money and provides it stability. It's important to remember why fiat is important for money. It's evolved historically, but there seems to be a tendency to forget it of late. It's important to remember that. A second defining feature, other than being fiat, of modern money is singleness. Again, something that is not discussed very widely. This is the property that different forms of money in an economy, cash, deposits, are denominated in a single unit, rupee, dollar, whatever, and interchangeable at par. This singleness also arises from the fact that settlement of all transactions take place in central bank money. This is important to understand. It's a bit technical for people who may not understand how settlement happens. It's important to remember that all settlements are complete only when there is a settlement in central bank money. There is a concept called finality of settlement. That happens when ultimately the entries are passed in the central bank. You make a UPI payment. The payment happens. Money goes from A to B. The transaction is not settled yet. The transaction gets settled when that money moves from A's bank to B's bank. And these banks have an account with Reserve Bank of India. So the final settlement happens when money moves from A's bank to B's bank in the books of the Reserve Bank of India. And when that happens, settlement is final. It cannot be reversed legally or otherwise. Singleness of money ensures that trade and commerce is smooth without any concern for the value of different types of money. It doesn't matter which bank's deposit you have. Everything is denominated in rupees. Everything can be converted at par to rupees. Ultimately, in modern economies, the fact that all money is fiat also ensures that money is single. This is a very important fact. If you want to understand what the risks of money that is not single is, just imagine a country where anyone can issue a currency, any corporate can issue currency. Let's say there are 10 corporates and including the fiat money, so there are 11 currencies. You will never know what price to pay for a particular good depending on in which of these 11 currencies it is priced. You will have to look at an exchange rate between currencies even within the economy. That is not a stable arrangement. Singleness is extremely important. Now let's sum up our understanding of what money has evolved into. So just summing up, that money represents value, please remember, trusted by users, that money is fiat, and that money is single. These are the attributes of money. Now, why am I spending so much of time in telling you what money is? It's important. It's important if you have to understand what cryptocurrencies are, what stable coins are, it's important for you to have an understanding of what money is. Now we will proceed to cryptocurrencies. What are the attributes of cryptocurrencies? The historical evolution of cryptocurrency is the outcome of decades of search. To the best of my knowledge, started sometime in the 50s, may even be earlier, for a cyber solution that for total anonymity of transactions outside of state control. For those of you who want to understand this, there is, I think, a 1989 or 88 document called the Crypto Manifesto. You can just search on your net. You will find it. It's a one-page document. It actually gives the philosophy behind the crypto movement as such. But please read that. The creation of Bitcoin in 2008 was the result of that search. Bitcoin, or rather the blockchain, the technology underlying the Bitcoin, demonstrated that a digital token can be transferred between unknown counterparts without the need for an intermediary. Now, this technology was revolutionary. It can have many uses if people can, in a trusted manner, exchange assets or goods without someone else guaranteeing that or authenticating that. But while the technology was certainly revolutionary, but the Bitcoin itself was just a tool to demonstrate the technology. It had no value, either intrinsic or as a promise to pay. It was not money. The price of Bitcoin today does not represent value in the same way money has value. This value is purely speculative, like the price of a tulip during the tulip mania of the 17th century, as some of you would be familiar with. As long as two people are willing to pay a certain price for a commodity or for anything, because as far as I understand, Bitcoin is not even a commodity, for anything, there will be a price for it, but that does not mean that there is value to it. To summarize, cryptocurrencies have no intrinsic value. They are not backed by any promise to pay. That is, they have no issuer. Since they do not meet the basic attributes of money, I reach the conclusion that they are not money. In fact, since they do not have any underlying cash flows, they are not financial assets as well. Please think of any financial asset that comes to your mind. It has to satisfy at least two things, that it is someone's liability or there are underlying cash flows. So, cryptocurrency is not a financial asset as well, or for that matter, any asset at all. It is just a piece of code. How about stable coins? So far we have been talking generally about cryptocurrencies, but what I probably have in mind is more like the unbacked cryptos like Bitcoins. How about stable coins? Which are cryptocurrencies against which the issuer holds reserves to maintain a stable value. Since they are pegged to a fiat currency, they can perform the function of a currency. Also, they are backed by financial or other assets. Because they are backed by financial or other assets, typically treasury bills, gold, they do represent value. Therefore, they have some of the basic attributes of a money. However, before we rush into a conclusion that they are money, we need to keep in mind two things. One, is there a promise to pay? For stable coins to be money, the issuer needs to promise to pay par value to the holder. The fact that it is backed does nothing for the holder unless someone promises the holder that I will pay you. All currency issued by Reserve Bank of India is backed by financial assets. But you still need an assurance of I promise to pay the bearer that you see on the face of your currency note or your bank note. So that promise to pay is important. Is there a promise to pay for stable coins? It is not clear, whether stable coins are the liability of their issuers. It would appear that neither of the two major stable coins in use today make such an unconditional promise. That is my understanding of it, but please check. There is no unconditional promise to pay. Second point that we have to keep in mind. Assuming that such a liability exists, that there is a promise to pay, let's assume it for a moment. The next point to keep in mind is that stablecoin is private money. It is issued by a private person. Therefore, stablecoins fail to satisfy the two defining features of modern money, which we have discussed at length a little while back. What are these? Money as fiat and the singleness of money. Right? There can be 100, there can be 1,000, there can be 10,000 stable coins in an economy. You will have 10,000 currencies. Imagine an economy working with 10,000 currencies. Singleness is violated and clearly they are not fiat. It is possible that in a stable coin system, there would be hundreds or more currencies in an economy, making any such system inherently unstable. Since we can reasonably establish that unbacked cryptocurrencies are not assets and merely speculative bets, akin to betting on a gambling event, we would focus in the rest of this talk on stable coins, who are at least backed and which has some characteristics of money, which are close enough to money to pose a significant challenge to the financial system. First, let's look at the benefits of stable coins that their proponents claim they have. The proponents of stable coins present a range of claims, the more important of which, we'll focus on the more important ones, are improved cross-border payments, cross-border payment efficiency, greater financial inclusion, and the ability to drive digital financial innovation. First, efficient cross-border payments. An oft-cited benefit is that stablecoins can make payments, particularly cross-border payments, faster, cheaper, and more efficient. In the domestic space, real-time fast payment systems such as UPI already enable fast, low-cost, and reliable payments. And there is no reason to believe that stablecoins would be superior from the point of view of either cost or speed or reliability. In the cross-border space, that's as far as the domestic space is concerned. In the cross-border space, stablecoins can potentially enable faster and perhaps cheaper payments than what the current corresponding banking system provides, mainly because stablecoins do not face settlement risks. On the other hand, it is not certain that stablecoin issuers would have the same degree of acceptability as international banks that are closely regulated and backstopped by central banks. Also, the purported efficiency is doubtful when there is a large number of stablecoins in the ecosystem. Please remember, when this claim is being made, there is an underlying assumption that there is just one stablecoin issuer in the globe. So you just have to get onto one blockchain and you can transfer money instantaneously without friction. There is absolutely no reason to believe that that will be the situation. Second, improved financial inclusion. Another claim often made is that stablecoins enhance financial inclusion by providing access to digital money for those outside of traditional banking systems. Now, financial inclusion requires solutions that are accessible, affordable, and safe. Many countries have made substantial progress in financial inclusion through digital public infrastructure and simplified account opening frameworks without the need to create parallel private forms of money. The inherent instability of stablecoins, we have examined some of those, means that they are clearly inferior alternative to fiat money as tools for financial inclusion. As stable coins remain dependent on smartphones and digital wallets, internet connectivity, and technical know-how, they may not be available to those segments of the population that are most in need of financial services. Third, stable coins as a bridge to the real economy. Finally, supporters of stable coins often argue that they can act as a bridge to the crypto ecosystem, to the real economy. Yet, the evidence today indicates that stable coins remain primarily used as instruments to facilitate trading and leverage within the crypto system itself. Their role as meaningful transactional currency in everyday economic activity remains extremely limited. To sum up, many of the benefits of cryptocurrencies are of stable coins are neither unique to stable coins, nor have stable coins yet established any of the benefits that the proponents claim. Most of this is as yet claims only. By their very nature, they are in many ways inferior to available forms of money. We have seen the attributes of money, and we have seen what stable coins lack in achieving these benefits. On the other hand, the risks they introduce to financial stability and broader macro financial stability are extremely serious. We will now take a closer look at these risks in detail before considering how India should approach stablecoins. Risks of stablecoins. Beyond the facilitation of illicit payments and circumvention of capital measures, stablecoins raise significant concerns for monetary stability, fiscal policy, banking intermediation, and systemic resilience. Risk of currency substitution, the first risk. A core risk of stable coins is currency substitution. Their design as currency-like instruments introduces the potential for currency substitution, particularly in emerging markets, where they could compete with domestic fiat money. Stable coins, whether denominated in domestic currency or foreign currency, this is an important point for you to remember. Please park it. We will explain that a little bit later. Whether denominated in domestic currency or foreign currency would reduce demand for the local currency and raise the risk of dollarization and other risks. Now, risks to monetary policy. Widespread adoption of stable coins would undermine the central bank's ability to control money supply and interest rates. The IMF FSB paper of 2023 actually says this: if both an official currency and a crypto asset are used for pricing goods and services, domestic prices could become highly unstable due to the inherent volatility of the crypto asset. If residents increasingly hold and transact stable coins, changes in domestic policy rates may have limited influence on economic decisions, weakening the effectiveness of monetary policy. Weakening capital account management. This is something that is very well understood. Stable coins pose challenges for capital flow management as households diversify their balance sheets by including foreign currency denominated stable coins. This trend could make it difficult for authorities to implement capital controls, which are a critical instrument for financial stability in many emerging economies, including India. The pseudonymous nature of blockchain transactions compounds these risks, as it creates channels for unmonitored inflows and outflows, diluting the effectiveness of capital flow measures and complicating both macroeconomic management and external sector oversight. Bank and credit intermediation. Now, banks are the primary entities that intermediate between savers and investors in an economy. This ability derives from banks' role in credit creation. To the extent stablecoins replace bank deposits, banks would lose their role as financial intermediaries, as the primary financial intermediaries. This would result in either a rise in the cost of credit as banks lose access to low-cost deposits, or Banks were having to depend on the central bank to provide the liquidity required to fund credit. A financial system that has to increasingly depend on central bank liquidity to fund commercial credit would not sustain. Loss of seigniorage. This is another point that has of late been getting more attention than it was getting, but an extremely important point. When a central bank issues money, it receives equal value that is invested in assets like government securities, which are used to back the currency that is issued. Now, these assets earn a return, which is significantly higher than the cost of printing and issuing money. Now, this difference, higher returns versus against the lower cost of issue, is what is called seigniorage income. This, which is transferred to the government by central banks world over. Since currency issue is a social function, seigniorage income rightfully belongs to the government as the representative of the people. There is no case for seigniorage to accrue to private profit-making entities. Yet, this is exactly what stablecoin issuers earn as income. Seigniorage, which is inherently a sovereign revenue arising from the issuance of fiat money, is thus diverted to private operators, often located outside the home jurisdiction. If stablecoins are denominated in foreign currency, it is likely that most countries would see a leakage of seigniorage income to private issuers of dollar or any other international currency linked stablecoins. This loss of government revenue does not receive the serious focus it deserves, not even from central bankers. Just think of the transfer, central bank transfer, the volume of that to the government, you would understand how significant this point is. Domestic coins, stable coins are not risk-free. Often argued by stablecoin issuers that, okay, issue it in domestic currencies. If you don't want to issue it in dollars, allow domestic currency. While such instruments, domestic currency instruments, may reduce risks to capital account management, the fundamental vulnerabilities such as currency substitution, a rupee denominated stable coin called, let's say we'll call it rupee 1, will replace fiat rupee, but it will still replace the fiat rupee. The fundamental vulnerabilities such as currency substitution, bank intermediation, reduced monetary price control, monetary policy control, most importantly, singleness and loss of seigniorage. All these would still remain even if you issue it only in the domestic currency. Can I have a bottle of water, please? This is the reason why advanced economies are also not immune to the risks posed by stable coins. So, stable coins introduce real and severe risks ranging, we have seen, from monetary and fiscal disruption to banking disintermediation. The risks are, perfect, thank you. The risks are significantly higher for EMDs, but there are also major risks for advanced economies. Understanding these vulnerabilities is critical before considering regulatory frameworks or policy adoption. It is not surprising then that global policy bodies and standard setting organizations continue to highlight the risks of stable coins. In the interest of time, I would not go into this section about what these international bodies have said about stable coins that I want to bring to your attention, but the speech will be uploaded on our website. You can read this portion if you are interested in that. Basically, these bodies like IMF, FSB, BIS, Bank for International Settlements, have all highlighted that there are very clear risks with stable coins. BIS, for example, says that stable coins fail the basic tests of singleness, elasticity, and integrity that any form of money must meet, and hence structurally unsuitable to anchor a monetary system. That is quite, sort of that's very clear about what the risks of, stable coins are. So what does all this mean for a country like India? How should we deal with stable coins and safeguard financial stability and monetary sovereignty? These questions naturally lead us to consider the domestic policy imperatives that must guide India's approach in this evolving global environment. For India, the approach to stable coins must be guided by caution and an appreciation of domestic imperatives. Stable coins can undermine trust in the currency and finance system. India already benefits from a payment landscape that is highly efficient. This leaves little justification for the integration of stable coins into the financial system for domestic payment systems, even before considering the broader risks they pose. I mean, even if we ignore the risks they pose, we already have UPI and other systems that are as efficient as any in the domestic space. There really isn't a case for stable coins to give added value here. At the same time, India must acknowledge the promise of innovation that technologies such as blockchain and tokenization bring. A central pillar of this strategy is the adoption and cross-border readiness of central bank digital currency. Or CBDCs. CBDCs are digital tokens like stable coins, yet they are inherently superior since they satisfy all the attributes of money. They are fiat, they are single, they are trusted, and they represent value that users can trust. And they do not pose many of the risks associated with stablecoins. I say many of the risks, I don't say all of the risks, because they do pose challenges for the banking system, which is one of the reasons, Reserve Bank has been a bit cautious about, launching it until you have an understanding of what that impact is. Some risks remain, but most of the important risks of stable coins are not there when you use CBDCs. They can perform all the functions stable coins claim to offer, such as programmability, atomic settlement, lower cross-border frictions, while being fully anchored within the existing financial system. Encouraging CBDC use domestically is essential and can be done by making CBDC functionally similar to physical cash, especially with respect to tiered anonymity that cash has. For example, ensuring anonymity of small value CBDC transactions, much like cash, would provide users comfort and trust while preserving safeguards for high value flows. Such an approach also avoids disintermediation risks for the banking system. The cross-border dimension is even more critical. Much of the appeal of stablecoins lies in their promise of cheaper, faster international payments. But the same efficiency can be achieved through bilateral or multilateral CBDC corridors. This is an area where India can play a shaping role by helping the case for interoperable CBDC arrangements among emerging markets and beyond. The third pillar of India's approach to stable coins should be interlinking of fast payment systems. The recent linkages between UPI and several partner jurisdictions are important steps that India has taken, increasingly reducing the need for any private digital alternatives to remittances. Finally, as we weigh policy choices, we must also address a central argument often made by proponents of stablecoins, who claim that the associated risks can be managed through regulation. Regulation can indeed mitigate some risks, but the larger questions continue to remain. Can we afford to experiment with the foundations of a global monetary and financial stability that have been carefully built over the years for instruments that lack the safety features of money, that are inherently risky, and that remain untested at scale? As highlighted in the BIS Annual Economic Report of 2025, society faces a clear choice, which is either to strengthen the monetary system using proven foundations of trust and advanced programmable technologies, or to risk repeating the hard lessons of history by relying on unsound private digital currencies with real societal costs. This is what the BIS has said. I will now conclude. We have seen that stablecoins lack the basic attributes of money. Their advantages are neither unique nor unambiguous, and their risks are all too real. It may be noted that we have not, in this talk, that we have not referred at all to the risks associated with the assets that back stablecoins, which is one of the risks you most commonly hear about, that those assets can fall in value, create instability. I have not referred to it. There is a reason for it. This is because it does not matter for either the benefits or the risks of stablecoin to materialize. In fact, the bigger threat is a stablecoin that works well. India stands at a decisive policy crossroads. Despite India having good macroeconomic conditions and sound policies, the domestic factors and compulsions must be considered when evaluating policy options for stablecoins. The choices made today will impact the future of our monetary system and financial sector integrity. India's strategy must therefore be clear and coherent, anchored in 4 key principles. 1, preserve trust in the national currency, monetary and payment system. 2, safeguard monetary sovereignty and macro-financial stability. C, encourage responsible innovation through CBDCs and interoperable payment systems. And finally, D, ensure that innovation strengthens rather than bypasses the regulated financial system. What I didn't tell you initially was what the title of my talk was. The title was Stablecoins, do they have a role in the financial system? I will end with my response to this question posed in the title of the speech. Do stablecoins serve a purpose? It seems to me that they do not. At any rate, they do not serve a purpose that cannot be served better by fiat money. Thank you so much.
Firstly, thank you very much, sir, because we managed to also understand the challenges as well as the opportunities around stablecoins, and most importantly, you addressed the big question that was also on our mind, so thank you again for that. But on that note, I'd like to now once again invite Mr. Ravi Krishnan, Editor-in-Chief, Mint, to spearhead a very important discussion over here. We'll take this chat forward, and with that, Ravi, over to you.
Thank you, Deputy Governor Rabi Sankar, for that enlightening talk, very professorial. But the approach which you have outlined seems to be the extreme opposite of what the US has done with the Genius Act, where they have kind of given legal banking to stable currencies, but not to a central banking digital currency. Is it because of their unique macroeconomic position and and where the dollar is? Is it because of that, or is there any other reason?
It will be difficult for me to to talk about what are the motivations or the reasons that US has. Clearly, US has certain advantages that virtually no other country has. Its currency is used in 90% of global transactions. And the two largest stablecoin issuers today, which account for, I think, more than 90%, or at least around 90% of global stablecoin supplies, are American companies. It is in their national interest, perhaps. Nonetheless, if you remember, one point I emphasized in my talk, that the risks that I highlighted also apply to advanced economies. They have these risks as far as I can understand it. But on balance, there have been statements that this is to perpetuate the global dominance of the dollar and all that. I have no idea whether that is the objective. But the basic point is that they would have their reasons. But I really don't understand why. But clearly, they are in a much better position than most EMDEs, countries like India are.
What has been the experience with the central bank digital currency? Wholesale seems to be doing better than retail. Is that due to a lack of genuine retail demand or some other factor?
Again, if we go back to this talk, one of the pillars that I highlighted that India should follow as its response to stable coins is to promote CBDCs. Why did I say that? I say that because it can do everything that stablecoin can do, just better. But it requires one underlying requirement, which is that it's presumed that every other country has stablecoins. Now, for many reasons, privacy issues in some countries, and for many other reasons, this was not happening at the rate at which the adoption of CBDC should happen. And the advantage of CBDCs will be reaped when a lot of other countries have CBDCs. It won't really show the benefits of CBDC, especially in the cross-border space, if only we had it and others did not. And there, I think I have very clearly noticed in the last 1 year when stable coins are becoming more and more prominent, that many countries, many large jurisdictions, certainly not US as you said, but many other large jurisdictions are looking very closely and very seriously at CBDCs as well. So I think it is very important for CBDCs to exist across countries and connected to each other so that you can actually show a use case which is superior to stable coins.
You have recently talked about, programmable CBDCs for specific use like subsidies, etc. Is there a concern that there will be privacy risks associated with these kind of programmable tokens?
That concern is there. I think that's one of the main concerns in US and in a few other countries. There are two things, I would like to say that for retail use of CBDCs, if you want CBDCs to have the same demand that paper currency has, then anonymity is unavoidable. It has to be provided. At the same time, these are digital transactions. Paper can be just handed over, there won't be a record. But digital transactions always leave a footprint. So it is difficult to anonymize transaction. It's possible. There are technologies which make that possible. But more importantly, we would require a legal backing. Even if it's possible to wipe out a transaction technologically, I think at least most public institutions would not do that unless there is a legal backing to such anonymity. So we'll have to build towards that anonymity to create that unique case for CBDCs for domestic use by retail. The advantages for wholesale, especially cross-border, is simply saving the huge amount of capital today banks employ in managing the settlement risk. All that can be saved. That is fairly clear. But for that, as I had told in the answer to the previous question, we have to have other countries have CBDC as well.
If CBDC adoption takes off much more than what it has now, would the Reserve Bank consider, a formal regulation for broader cryptocurrencies?
I didn't, see the link, but it is not really, what Reserve Bank considers, because CBDC is something issued by the Reserve Bank. So Reserve Bank cannot issue something that, regulate something that it issues itself, like paper currency. But Reserve Bank is the central bank, so we would take all, all safeguards that are necessary to make CBDC work and strengthen the existing financial system and avoid weakening that financial system. Whether we would have a regulatory approach to other stable coins or cryptocurrencies, I think what I told you is largely my view of what stable coins are. We live in a country, different people have different views. Ultimately, it is for the government to decide what the approach of our country is. I just gave what, what I thought my, my contribution to that was. But I'm sure, when all stakeholders sit together and decide, we will decide on what the final approach of India is going to be.
So there have been these ongoing discussions about the 30% market share cap for UPI apps. The deadline has been extended till December 2026 now. But what is the RBI's current thinking on that?
It has been extended. So very currently, I'm not thinking about it. But the basic issue is it's difficult to implement. How do you implement a cap? Can you ask an entity that is actively doing business to say that you stop acquiring customers? And this is on, number of transactions. How do you tell someone that, okay, when your transactions hit 30%, then you stop doing transactions? You can't really do that. Even if you give that instruction, how would that entity, unless it closes down access? So it is difficult to implement without actually affecting the access of the UPI system to others. It has been postponed. We are just hoping, and we are encouraging, and we are taking steps to ensure that more and more people come in. We are seeing that now. I think the best way of achieving that result would be if other players come in, at least 3 or 4 other players, and that is more evenly distributed.
So there are 2 related issues. One is, of course, concentration risk. We see in another sector recently where an entity which has a 65% market share has virtually arm twisted the regulator. The second issue is many of these, the top 3 players are all foreign owned. So what about digital sovereignty and de-risking the Indian system?
2 things. First of all, on concentration, I'm not unduly worried. It is, strictly speaking, not market share. You see, these are third-party apps, right? UPI is a transaction between 2 banks. So the share of business that the third-party app has does not matter so much for a system that facilitates transaction between 2 banks, which is very distinct, very different. And even if the concentration risk, even if something happens to one of those 2, there's no risk to the system. I think most people in any case have more than 1 app installed. But even if they don't have it, it's a matter of time before you just install another app and do it. So in terms of concentration and what risk it can cause to the UPI system, I don't really see, that risk to be very significant. Well, sorry, what was the second part of your?
About digital sovereignty, how these are foreign owned.
You see, we are open. We have an FDI policy. We want foreign capital. Foreign capital comes in, invests in according to the policy we have. So I really don't think that is an issue, that I would really be thinking about when I'm talking about UPI.
The other thing I wanted to ask you about was digital arrests. We see quite a number of instances where people are losing their life savings sometimes because of this, and it is getting more sophisticated by the day, these kind of attacks. And many victims of digital arrests whom we have spoken to in course of our reporting they are not quite happy with the role which the RBI ombudsman is playing as a protector. Is there any plan to revamp the system? Are you looking into it?
There was recently a Supreme Court order on that, on digital arrests. Investment frauds, digital arrests are some of the more potent frauds. They're the more severe in terms of quantity and number than payment frauds, which tend to be small ones and can be controlled. But they are very severe because people have lost large amounts of money, people have lost their life savings. This is something that has to be approached very seriously, which is exactly what the Supreme Court has said. I think we have to put in a lot of efforts. One effort is, of course, on ensuring that such frauds do not happen. There are certain efforts in that direction. There also has to be efforts in ensuring that if they have happened, then how do we develop a system that maximizes the possibility of recovery? A lot of effort is involved. Reserve Bank has a role to play. Banks have a role to play. Other, in the ecosystem, law enforcement agencies have a role to play. We are looking at that. There are, we have developed some technology, for example, a mule hunter, which we expect that over a period of time, as its efficiency continues to improve even further, we will be able to identify mule accounts and, therefore improve the chances of recovering money that has been, taken out through frauds, including through digital arrests. There are other efforts as well, but this is something that is serious, that needs to be addressed and requires coordination across the ecosystem.
Any information you can share on the success rate of the mule hunter? Has it been successful in curbing?
So far it is working on in about roughly 20 banks. The success rate of that is about 90%. Which is good, but then this has to improve further. We have to take that to the 99s, but that will happen when this machine learning system learns more from more data and keeps learning and relearning. We will get there. We'll get there. Most of the banks have come in. Once the remaining large banks come in and all that data becomes available, we should be able to get there.
We are out of time, but one audience question we can take. Just one. Yes, Ms. Kuriakos.
Sir, you have made your stance on cryptocurrency, that is RBI's stance on cryptocurrency and stable coins very clear. So why isn't the regulator and government taking, complete step against stopping this trading? Because today India is among the top 3 countries, I believe, as per news reports, in terms of cryptocurrency adoption. And now we are hearing that in villages or tier 2, tier 3, people used to buy land, and now it is land plus crypto. And there are crypto academies flourishing, etc. So why don't we just have an outright ban on exchanges who give this, etc.? Because it's very clear that it will undermine our monetary sovereignty and all the other risks associated with it.
I agree with you. It's very clear to me. It's very clear to other people from RBI have also spoken about it, and I'm happy to discuss it or debate it with anyone who thinks that any of those arguments are not justifiable. We are happy to do that. But then, you see, at the end of the day, that is our view. As I told in an answer to an earlier question, we live in a democracy. There are different stakeholders. There are cryptocurrency or stablecoin issuers. There is the government. There is the banking system. It might also have a view. We have to look at all these stakeholders before a final decision can be taken. I think what you're saying is that decision should be taken sooner rather than later. I think that's essentially what you're saying. But I'm sure, you know, it is under consideration. It will be taken early. Ultimately, we'll have to, you know, all finalize our approaches and our actions based on what that decision is.
So, in your eyes, is investing in crypto equivalent to real money gaming?
I think I strictly don't understand what real money gaming is. I have not done one, but I think it's clear in my mind that unbacked cryptos are pure gambles. They're pure gambles in the sense of mathematical bets. So an event has to happen, you just bet on that event. I give one example for people to understand how, you know, if they don't have any value, do you think people are fools to pay $100,000 to buy those? The point is, you could have asked the same question to people who bought those, you know, tulips, right? A flower which has a shelf life of probably a week, I don't know, maybe less, but people were willing to pay the price with which they could buy, you know, riverfront chateau or something. People were willing to pay that. So that craze happens. It happens when you think, you don't really think what it's worth. You only think whether I'm able to sell it for a price higher than what I bought it at. And that craze, as time and again history has shown, happens you know, all the time. You see, you and me, if we pick up this bottle of water, I sell it to you for 100,000 rupees. You sell it back to me for 100,000 rupees. We put it on a, you know, on a ledger. Then this bottle has had 2 transactions worth 100,000 rupees. I have given you nothing. You have given me nothing, right? But that, if more, you know, another 50 people do that, there would be another 100 people who will think, oh, there must be something special with this. So let me see if I can buy it, you know, around 100. That will be the price. That won't be the value.
Thank you.
Thank you. Thank you very much, sir. And thank you, Ravi. If I could also request Ravi to present a token of gratitude to Shri T. Rabi Sankar ji for joining us this afternoon here and for taking us through an interesting masterclass, if I may put it that way.